I'm Josh Duvall, certified financial planner, registered tax preparer from Joshua Duvall Financial Planning and Accounting. I hope you're doing well. Just wanted to come on here, make a quick video and talk a little bit today about how to understand investing over the long term, even with periods of high inflation or concerns about international crisis or other things that might be happening that would give you pause about your investment strategy moving forward. And so I've had a number of conversations with people over the last few weeks, specifically related to investments and kind of how to think about their investment portfolio or their investment strategy moving forward. I'm going to be sharing my screen in a minute just to provide a visual for you, but I thought I would kind of talk about this because I think it's relevant as you try to make decisions and stay on track with your investment program throughout what can be seemingly pretty difficult times with regard to what you hear in the news or headlines and so forth. So again, from my standpoint as a financial planner, as somebody who's focused on taxes and planning and investments as a holistic package for my clients, decisions related to your investment portfolio should not be reactionary related to headlines or market decisions or things that are happening only in one sphere that affects your overall life. Your investments should really be connected. Your investment portfolio, your strategy, your process for moving forward should really be connected directly to your specific goals, your risk tolerance, your time horizon, what the money's earmarked for. Is this going to be a down payment for a house? Is this college funds for your child? What is it that you're trying to accomplish with these individual funds that you're putting aside? What's the best way from a tax standpoint in order to get to whatever your goal is that you're trying to achieve? And then how do we do that in kind of a programmatic way, so that you're really staying on track of a process instead of kind of emotionally reacting to different stimulus or other things that are happening in the markets. And so I think it's an important conversation to have. And what I wanted to do is share with you, and this actually comes from Putnam Investments. I'm not connected to them. I don't have any kickback or financial relationship, but I thought it's important. I wanted to share it specifically so that we could get a chance to kind of look at how this, how this plays out kind of visually and from a graphic standpoint, related to a more of an index-based philosophy of long-term investing and not being so concerned about trying to time the market related to geopolitical crisis or inflation or Federal Reserve raising interest rates and all these types of things that you hear about. So I'm going to go ahead and share my screen here and just kind of talk you through this graphic, which I think is so helpful. So again, this is Putnam Investments, and they've put this together. You can go out and find it online. I can link to it as well. And here's the headline: "Time, not timing, is the best way to capitalize on stock market gains." So this is a 15-year period from the end of 2006 all the way to the end of 2021. And so what we're looking at here is just to kind of give you a brief context. If you were to invest $10,000 starting in 2006, go to sleep, and then wake up at the end of 2021, that 15-year period, here's all the different events that would have happened, right? We have the financial crisis in 2008. That's that long drawdown there between 08 and 09. We have the credit rating drop that happened here. We have Brexit, where there was a drop in stock market there, also connected around the election as well. If we look over in the over here in 2018, 2019, related to the Fed policy error and the significant drop that happened regarding trade relations with China. I don't know why they don't call this one out. I think this would be an easy discussion point and all very relevant to us. But if you look here in the 2020 sector, there's this significant COVID-related drop where we have the COVID shutdowns and a massive drop in the stock market. And again, so over the course of that 15-year period, we have from 10,000 all the way up to $45,682. That's the return of the S&P. So if we break that down into trading days, there's about 4,000 trading days roughly over that 15-year period, right? So not including federal holidays, weekends, etc. But the stock market is trading about 4,000 days over 15 years that we just looked at. The point of this whole conversation is what happens if you stay fully invested, right? You create a program, you keep connected to that program, you stick with it, you monitor and adjust over time, but we're not going to cash because we're scared. We're not moving into gold or moving everything into oil or into some alternative or moving out of equities and into 100% fixed income out of some sort of reaction to what you think might be happening or what's likely to take place in the future. Someone who stayed fully invested in the S&P would have had an average annual return of 10.66%. Now, again, I talk to my clients about needing 7% in order for your capital, your principal, to double every 10 years, not including contributions. So if you earn 7%, again, this is about 150% more than that. This is 10.5 plus. But if you earn just 7%, your money, your principal, what you've invested, not including any new contributions, will double every 10 years. That's pretty significant growing power or wealth building power. And that's kind of the goal that I have with a lot of my clients. So if you stay fully invested, you're at 10.5 plus percent. What happens if you miss only 10 days, only 10 of the best days of market returns out of almost 4,000? Well, your return has been cut in half. Instead of earning 10% a year, you're now only at 5%. What happens if you miss the best month, the best 30 days? And again, we don't know what those days are, right? So the only way you know what the best today might be the best day in the stock market over the next 15 years, we don't know. You only know that by looking in hindsight. But the reason why a graphic like this matters is because if you miss the best 30 days, and they might be 3 days in a row, and then you won't have another day for 5 years, we don't know. It's over the course of 4,000 trading days over 15 years. If you miss just the best 30 because you went to cash, because you moved 100% to fixed income, because you went into gold, whatever it might be, your return is now negative. You started with 10,000, now you've only got 8,300 and change. The point that I'm trying to make with a graphic like this is that we really need to think very critically about the cost, future return cost that we're going to have by making kind of ill-timed moves in the market. How do we know what the market's going to do tomorrow? When we look back historically, even during COVID was around in January, it was around in February, people knew about it. And yet the stock market still went down 30 or 40% over the next couple months. And so we just don't have a good understanding of what's going to happen in the future, right? Nobody has a crystal ball. What we really need to be thinking is not short-term reactions, but instead understanding how our investment program is connected to our goals, our time horizon, our risk tolerance, what it is that we're trying to manage from a tax standpoint, understanding the best most tax efficient way to structure our investment program, and then monitoring and adjusting those things over time as we have different needs, as opposed to knee-jerk reactions related to things that happen in the stock market or in world events or financial headlines. So I just wanted to share that with you. I hope it's helpful. If you're a client, obviously, would love to talk with you anytime about what's happening in your investments and maybe a way to help better understand how we can move things forward in a way that you're comfortable with your program. If you're someone who's maybe a tax client or potential client and you'd love to have a more in-depth conversation about your specific circumstances and maybe what could be done from a planning, investments, and tax standpoint for you, would love to have that conversation with you. Please feel free to reach out. You can shoot me an email, josh@joshuaduvall.com. Again, that's josh@joshuaduvall.com, or you could go to joshuaduvall.com and fill out a form on the website there. Would be happy to get in touch. So hope you're doing well. I hope this has been helpful for you and just a visualization that timing and missing the market is a great way to decrease your returns. Instead, let's focus on the things that you can control, how much you're saving, how much you're spending, the tax strategy that you're using in order to reduce your income tax or shelter income from taxation, provide more efficient ways of saving and investing for the future. And let's let markets do what they seem to be very good at, which is growing over time. So I hope you're doing well. I hope this has been helpful. Thanks so much and have a great day.